Hey everybody, welcome to Trading Capital's Daily Analysis video. Today is currently October 10th. Yet again, another positive day for the markets. It was off to a wild start when we had that gap up in the overall S&P. This chart's a little bit messy. I'm just going to remove some of my intraday day trade lines there. But overall, you can see the SPY got rejected at the key neckline. The head and shoulders, left shoulder, head, right shoulder neckline. Now, it doesn't mean that it can't get above there and get a daily close, but it does show that it made an attempt and it got rejected with a pretty long wick. You can see intraday that once you pierce that level where you came into this daily gap window over here, and we never officially filled the gap, you saw some pretty hard selling take place in the overall indices. Now, this type of selling is most likely going to be creating an intraday wedge pattern, a falling wedge, which does ultimately more likely lead to another bounce up in the market. But on the daily chart, resistance has been tagged. This is the big level that we need to hold if you're a bull. We don't want to get rejected and start falling too low in this trend, because if you say take out this daily low that we made today, intraday, that's going to be a negative sign for the markets. There's a slight gap there, but you don't want to take out this low on the SPY ETF, which was trading at, let me just remove some of these. So the low is 432.53 today. You don't want to lose that low. Now, looking at the SPX, so the SPX is a little bit different. Ultimately, you can see that the SPX got a close above the key neckline. No matter if you use the ultimate pivot low in this right shoulder, or if you actually run through the lower end of the body range, you got to close above that key neckline. So that leads me to think that because the SPY was so close to piercing through this neckline, and the SPX actually did get the close, it leads me to think that we're likely going to see the SPY ETF charge for this gap fill. It probably favors a little bit more upside, but obviously tomorrow we have to be aware of that there's PPI in the morning. So 8:30 a.m. that PPI data can come out. That's generally a forward-looking indicator for the inflation, the CPI rate, and we'll just see what the bonds do. Obviously, if a hot number comes in, hotter than the market's expecting, that's going to spike yields. So let's take a look at the quick yield market here. The US 2-year yield is ultimately what tracks the Fed fund rate the most. The 2-year yield has had a sell-off going into this PPI report, which ultimately puts the probabilities that you could see a little bit of a surprise to the upside. Right now, the bond market is pricing in a little bit more of a decline in the Fed fund rate, the forward Fed fund rate expectations. But needless to say, if we draw some trend lines on the 2-year yield, you can clearly see we just hit support today on this key trend line. A loss of this trend line, and ultimately you're probably going to test this hammer candle reversal that was made on September 1st at the beginning of the month there. So interesting to note this price action, but we are under 5% on the 2-year yield. If you take a look at the 10-year yield, because that's a longer term yields, it's right now still under the 2-year yield. So you have that short end of the curve inverted. I've been calling for my members that once you see the 10-year yield above the 2-year yield, so you take the difference, 4.95 minus 4.65, you have about a 30 basis point spread difference between the short end of the bond curve and the long end of the bond curve. And typically once that uninverts, that's when you see that initial selling start to take place in equities as the bond market is pricing in more of a disinflationary trend. And right now, the trend over the long term is still more inflation. Why? Well, look where yields are. Yields are still trading above this key resistance. Very extended on the weekly chart, but you're still trading above this key trend line. And right now, this is your big support level. If you start falling below this white trend line, you have another pivot high here, you have another pivot high here, double top. So there's two big levels down below, still holding about 4% on the 10-year, that will act as big support in the charts. I mean, simply if you look at these moving averages, the 50, the 100, look at this bullish alignment. Even if you look at the 20-day moving average, you're still way above that. So lots of power in this overall uptrend. You did get this bullish cross again of the 20-week moving average and the 50-week moving average. The last time we saw that bullish cross was really around here, this consolidation period. And look what happened to yields. Yields ended up soaring and roaring to the upside. Is that going to happen again? It could. I'm looking at the 20-year yield, and I still have this beautiful channel that I have discussed with some of my members, and you can see that what if we get to this 5.7 on the 20-year yield? You know, that's going to be a pretty powerful move. You've got major pivots, pivot, rejection, pivot low, another kiss of this pivot low channel, and this would be a symmetrical measured move. If you take this low to this high, take it from this low all the way to the top end of the channel, that would be a perfectly measured move in the bond market, and it's kind of scary to think that that could happen considering the charts are setting up that way. All right, let's move along to what else transpired. The QQQ, let's touch base on the tech right now. Daily chart I will flip to. Right now it's still putting in a larger term weekly bull flag pattern. It doesn't mean it can't chop to the high end, go back down to the low, but right now it looks to be that you want to test the high end of this range. You did get rejected off this wide range red bar here. So we have to be mindful that this was a big daily breakdown bar a few weeks ago, and basically you got rejected with a big wick. Intraday, what does that selling look like? Look at that. This could actually be shaping up to be a intraday bear flag, which ultimately likely means we see more downside tomorrow. But a new day with PPI, if PPI comes in better than expected, markets will negate that technical intraday pattern and could push higher. But right now, it could mean that there's a little bit of consolidation, sideways chop in the overall indices. IWM was actually the strongest today, and that's healthy to see considering small caps are leading. Let me actually just take a look at the TNA since IWM is a little bit messy with all my trading shares, but you can see the TNA basically almost tapped the 20-day moving average here. It was the outperformer in the market. The IWM finished up 1.11% as opposed to the Qs and the S&P just up 0.5%. So we'll see what happens here. The VIX is at an interesting level. The UVXY just had a 5-day pullback into a key moving average. It's tapping the 20-day moving average. And one thing I'm watching here, okay, are we going to create a little bit of an inverse head and shoulders pattern on the VIX? If this is to occur on the VIX, that would not be a healthy sign for the market. I mean, simply speaking, you have to develop this right shoulder still. Although there's a lot of right shoulder development here, you just need the VIX to start curling up. But if this does curl up and break to the upside, I mean, you're talking about a VIX move of up to 25-30 or so on the overall UVXY here, and that could mean some detrimental downside to the overall market. So watch this closely. Watch this rounding. Obviously, the pattern isn't technically fulfilled or in play until it breaks the neckline. But really watch this curling action, because you had this big sell-off in the VIX, and now you've been starting to flatten out the 50-day moving average. And generally when you're starting to flatten out the 50-day moving average, it's a sign, it's a short-term sign, or it's actually a medium-term sign that perhaps the trend is on the verge of changing here. And considering the trend has been to the downside, it's going to be interesting to see if that does change. Now, simply also, if we look at nat gas and then oil, so natural gas had another update today, still inside of that wick high, so you still have this little bit of a sell candle pressure. You're still trading at this big resistance right here. I still think nat gas needs to either consolidate more for another 1 to 2 weeks or pull back. Obviously, with PPI, that could be influenced tomorrow, and then Thursday you have the natural gas stores that will be released. If that surprises to the upside or downside, you could get a big reaction, but you are at resistance, so pullback is favored, and this is a pretty strong resistance in an overbought state. You're still trading at a 78.78 RSI on the daily chart, and again, that's still a very lofty level right now. But commodities do have a tendency to overshoot in both directions. If you look at the choppy inside day here, you had a big move up, big move down, big move up, made a little bit of a higher low, and now you're trying to test this double top and maybe pierce this level. But the big intraday levels, you're creating this wedge pattern. Which way is it going to break? Do you break to the upside out of this wedge, which could yield a much larger move, or do you break the downside of this wedge, which could actually push you back down to about 339 on the charts? Time will tell. Certainly interesting price action ahead in the commodity market. WTI crude, so looking at the daily chart of oil here, oil's interesting because if oil puts in this head and shoulders formation, this rounding top, that's going to be extremely interesting. So I discussed a few days ago that this was the big level. This is the big level of resistance, this pivot to this pivot. It's funny enough that oil gapped up, closed above, and now basically closed on that daily pressure. And what was interesting today is oil saw downside minus 0.72%, but the dollar was also down. The Dixie fell yet again. So the Dixie had a fairly decent down day of minus 0.28%. You are hitting support right now in the Dixie, so you know what that means. Typically when you hit support, a bounce usually ensues, and if that PPI number comes in hot, you're going to get a spike in the dollar. Simple as that. And considering the dollars had 1, 2, 3, 4, 5 day pullback, I would favor a bounce off of the support level. Just maybe we make another right shoulder before the dollar has a little bit more downside, or perhaps we just start making a higher high in this scenario. Time will tell, but the dollar is trading at support. And when I found that very interesting, because oil usually catches a bid when the dollar's down, and it didn't. Oil was negative, the dollar was negative. Gold was also negative on the session despite the dollar being down. So a little bit of a negative divergence there in the sense that gold and oil were acting weak even though the dollar was weak. That's not a healthy sign for the overall underlying commodities when its high correlation counterparty is weak, but those two underlying assets are also weak themselves. But big bounce in the market today. We took profits on quite a bit of different stocks here, with GDX banking 6.9. We banked on a Russell short. We banked on an ENPH. That was an epic move on ENPH. We unloaded some around the high, around 127, give or take. So definitely ENPH is on watch for this wedge breakout. I would favor a check back to this breakout and then potentially making another move to the upside. So if you see a check back to this breakout trend line here, that is another entry opportunity on the long side, in my opinion. One sector I want you to pay attention to, and one thing that I'm starting to nibble on the short side, and we've been long for the last couple weeks, but financials, XLF, you're hearing a lot of chatter with regarding potential short banning on financial assets. Again, potentially that the banks are still very well positioned with the discount window, but one thing's for certain is that discount window was really only, from my understanding, valid for 1 year, and the market's forward looking. So I think we're approaching about 6-7 months in from that discount window. So perhaps, and as we head into the bank earnings, perhaps we're going to see some downside, but this is the trend line that I'm looking at. You had your bearish consolidation in this range, you just tapped that today. And considering the IWM has been exceptionally strong, financials have had a nice 5-day rally right into resistance, I'm favoring a little bit of a pullback in some specific financial names. There's certainly some that are stronger than others, but there's some that are weaker than others at the same time. But I do, at the minimum, I think we get a pullback, probably back down to about 32 to test this inside consolidation bar. That's your high volume bar that was made on October 9th. I think we're going to get a retest of this low, and if you hold that low, you could actually make another move to the upside. But if you lose that low, then it likely means that I think I have a target of around 31.40 on the charts. And let me be clear, there is still a valid daily head and shoulders that did trigger. So perhaps we can push all the way up and get a retest of this trend line. You do have two trend lines of confluence, but this head and shoulders, where you have this left shoulder, this head, this right shoulder, that triggered. It hasn't completed its downside move, but it triggered pretty aggressively over here to the downside, and now we've had a beautiful bounce. So you typically want to see, now after a nice bounce, what type of consolidation do you get inside of this bearish topping formation pattern. So time will tell, but again, there's also some larger patterns, topping formations that could be at play in the overall financials. And considering rates have been still on an upward tear and in an upward trend, if that PPI number comes in hot and spikes yields again, that's where financial margins, I think, are going to get squeezed. And we may also see some fear and profit taking come into the financial markets ahead of the big earnings reports that start up very soon. One stock I do like on the long side, there's been some unusual call flow volume. It's a pharmaceutical stock. APLS is the ticker. A couple things I'm going to run through here on APLS. All right, first thing first, you had a bullish crossover of the RSI. Typically in these pharmaceutical stocks, when you get that crossover, you do see more upside. Maybe you get a short-term pullback, but you do usually see more upside. One thing I also want to bring to your attention is that if we remove this trend line, this was when you had your bearish break, pivot to pivot, you had your wide range impulse breakdown candle through this trend line. This is almost like a little mini failed breakout, turned bearish, putting in bearish consolidation. Now this failed bearish pattern is turned bullish again. Why? Because it's gotten above this key trend line and it's actually made a higher daily low from this hammer reversal candle. So that's a bullish sign. I think at the minimum we can see a retest of this major pivot high, and ultimately I have been seeing some bullish call flow up to the $61 mark. That's just right around the daily 200 moving average, and it's also right around where you have this major upsloping trend line, your big break in the overall trend that had your wash out capitulation low. So combining a few factors, a potential reversal in the trend, bullish call flow. This is a very risky stock because it is a pharmaceutical small cap stock, but it does trade a decent amount of volume each day on average. So it's one that I'm prepared to put a small amount of my portfolio in, and we did pick up a little bit of that APLS today, just as like a little bit of a high spec play. Typically, even if you get a market sell off, pharmaceuticals have a tendency to diverge from the overall market. On that note, I'm going to end this video here. I'll touch base on a few other things in another video, but please give this video a big like down below. Write a comment if you agree or disagree, and I'm interested in hearing any other potential trade setups that you'd like me to review in the coming days or weeks. And if you're interested in how we're trading some of these crazy market movements, definitely check out our website at tradingcapital.com.